You got to think about pulling the trigger as a buyer. Hey everybody, Jaysen Barlow, aka JB Barlow Bad Boy, co-founder of Sell for 1%, here with my dad, opposite the other co-founder of Sell for 1%, head broker Dave Barlow. Got Jaime Barlow, Michael Jack Hopper, and Richie Rich Cereone with Equitable Mortgage. We've got all kinds of volatility in rates, lots of information, misinformation out there. Rich, what the heck's going on, man? What's the word?
Well, we got higher rates right now. That's just where we are. We're pushing at 7% on the 30-year fixed base kind of rate. Of course, as we discussed many times over, that there's a sliding scale of rates depending on credit and loan to value. But you know, if you look at like the base factor type rate, we're 7 or above this morning as we speak. The Fed has raised rates to the point of 500 basis points since they started to raise, which is a significant amount of ground to cover in that period of time. I think 18 months or something like that. The only bright side that may manifest itself is next week, the Fed meeting. Some people feel they may pause because just to take a wait and see approach, because when you raise rates, it doesn't immediately affect the economy. You raise rates and it's a lagging indicator. And there's economists out there now saying, hey, we need to pause and we need to see what happens and give the rates time to work their way into the economy. So if we see a pause from the Fed next week, it could be positive for mortgage rates. And again, it depends a lot on what their language is, what they telegraph to everyone as far as the future rates go. So as of right now, we don't have any relief in sight, and we're hanging on what the Fed does next week.
Yeah, that was one of the early critiques of them raising rates, was raising them so fast, so quickly, was it takes 12, 16 months, sometimes 18 months to see the impact. And so it's like I think we're not even a year. I think September was when we got to pre-2019 levels. So before like the COVID levels. I mean, we're not even a year from rates getting back to those levels. And they've raised them so much, you know, and left kind of a wake of destruction in the path. I mean, I don't know, you know, what's on the horizon, but, you know, you would expect to see, you know, a couple more banks at least, you know, fail. And that won't impact mortgage rates, but the economy at large is going to get interesting to watch. I would expect to see them to pause as well and not just, you know, march forward. But, you know, for buyers that are, you know, in tune to all this, and sellers, we notice for our sellers when rates, you know, spike, you know, the amount of offers slow down, which of course seems like common sense. So if the Fed pauses and mortgage rates, you know, kind of rebound a little bit, that's going to be one of your best times to strike as a buyer and a seller, because they're signaling they're going to continue to raise, you know, due to the jobs numbers being better than anticipated.
Right. And then the jobs number, there were people out there pointing out what we mentioned last week, that the jobs that we're seeing being created are restaurant, leisure, hospitality type jobs, not your bread and butter jobs that really drive the economy. So that's another thing that maybe is in the background of what the Fed might be thinking about next week. But it's anybody's guess what they're going to do. They seem to be very hawkish. They have a few Fed governors who are dead set on continuing to raise rates, and they speak about it on CNBC. So anything can happen next week. We really don't know.
Well, and it seems like maybe they have the Fed has lost touch with how values move slowly. Values don't shoot one way or the other in reaction to quick action from the Fed. Values are slowly, still here in Columbus at least, grinding upwards. And I think overall values will continue to move slowly, and hopefully with a pause, it'll give us a little reprieve from them trying to counteract values. So that's what I think we're seeing.
That's one of the things that Dad and I have talked about the last couple of days, is the Fed is looking at, and I did numbers the other day for a customer, and in Columbus schools, as of April, was up 9% from last year to this year. And so, I mean, you know, we've had lots of discussions in our group about where the market is and where it's going. And, you know, there's a narrative out there that, you know, the market has been, you know, is crashing, is going down. But the reality is that, you know, in Columbus School District, it's up, you know, a solid 9%. I mean, that's a great appreciation rate, you know, even, and that's with, you know, interest rates. They started to go up, you know, they were already up, you know, by last April. So, I mean, I think you're starting to get kind of a very, you know, clear year over year when we're doing those comparisons. And it just, you know, it's an interesting market to be in as all this, you know, turmoil is unfolding around us and prices are still climbing. And, you know, it's for the buyers who have sat on the sidelines and watched rates go up, they've gotten zero relief on pricing. And so, you know, you really got to think about pulling the trigger as a buyer. You know, and I'm someone that, you know, me and Dad go round and round, you know, about this. And again, because of the prices going up in the real estate market, the Fed is looking at this whole thing going, we still have room to raise rates. And so, you know, I know that there's been a lot of projections that rates are coming down and we're going to be in the mid fives. You know, all the indicators from the Fed and the governors who are influential that sit on that board, they're going to keep raising them in the short term. And so, you know, unless you're banking on total economic destruction and collapse, you know, you're best to buy as soon as you can versus waiting for rates to come down, because prices aren't slowing. You know, they're going to keep raising rates and prices are going to keep climbing because there's a supply and demand issue. Anybody with a 2%, 3% rate, meaning rich, you know, we know they're not super eager to trade that for a 6%, 7% rate. So you have people that aren't listing their homes. It's going to become a very interesting dynamic. And so I'm looking forward to seeing where it goes, because I know all of us here, we're all going to be just fine. You know, the market will chug along and, you know, people will buy and sell, and Columbus, Ohio will be an anchor for the state. And so I don't expect anything, you know, nuts to unfold, but, you know, buyers that are planning on that, you really ought to start looking at what the signals are for where rates are going, where prices are going, and, you know, reconsider waiting for the correction and try and jump in when you can.
Right. I think what you're saying is if you're looking for a $400,000 house, you waited a year, that $400,000 house is now $450,000.
And rates went up.
So you've lost and rates went up, and you've lost $50,000 in equity that you could have captured last year.
Yep. And even it gets, those numbers get crazy. Because I mean, me, Mike, and Jamie have had a lot of buyers that 3 years ago, 4 years ago, when, you know, in 2018, when the market was starting to pick up steam and it was starting to become normal to have, you know, 50 people at a showing, those people that said, oh, we're going to wait, it's too crazy for us, those homes that were at 200 are now at 350. And I mean, it's amazing the amount of money that's been left on the table.
Yeah. Well, and the other economic thing to watch here is what is going to happen with the regional banks. There's still a lot of talk that they're in trouble, even though announcements every day that their liquidity is fine. There's a lot of dubiousness about that statement. And then, of course, commercial real estate is in trouble, and these regional banks holding a lot of commercial real estate in their portfolios. So this is going to be interesting to see how that plays out over the next 18 months or so.
Right.
Yeah,
And what I think the
I put research
correlation
in that one to see what the impact of the commercial market will be on residential. And I'm sorry, I didn't mean to interrupt you, James. I don't know if Dad has any thoughts on the crossover there between commercial and residential, or Jamie, if you do what I know you had that fish market that you sold. It's like it's a very touch and go deal all the way around.
Well, and on the commercial listing I had, it was nothing like a residential listing. Prices are higher for commercial, believe it or not, much higher. And at least, and I know Dad has some commercial deals too. They sit a lot longer. I don't think there's much of a correlation besides the amount of money that banks have in them and what that effect could have when these potentially default. But I don't think that they're very correlated to residential. I don't know what Dad thinks on that.
Well, the type of commercial that we have is more small business stuff.
Yeah.
And so it's going to be different. I forget, there was just a big building here in Columbus that just defaulted. A big office building downtown. I forget.
Cover My Meds, maybe?
What is it?
I know Cover My Meds is moving at least. I don't know if...
Well, they just built that new building there on 70, but there's a big office building. I forget which it was, but they just defaulted on their payment because it's only, a quarter occupied. And that all happened as a result of COVID and people going home. And so, these are 25, 30, $40 million buildings that are defaulting because they don't have the occupancy rate versus what we normally deal with, our small business. You had the fish market. I've got a couple of, smaller pieces of commercial property that are going to be small entrepreneurs who are, looking to open their own business and do their own thing or expand what they're currently doing. So it's a little bit different. When you start to talk about, buildings that are, 30, 40, $50 million buildings, that's a big chunk of change. We sell several hundred homes a year, and I haven't, done the math, but how many of our houses at 40 million, we'd have to sell about 90 houses to equal that. So it's a bigger chunk if you have 4, 5, 6 of those. I know the Huntington building downtown is very lightly occupied. I think I read Levesque under new ownership that they're pretty much 100%, but they converted a lot of those into condominiums, and I don't think they're selling them. And that may be an issue for those guys, but anyways, that's interesting. Yeah, like you say, 18 months, will tell the true story of, what happens. I know Nationwide, I just read about them a couple weeks ago. They're consolidating. They're closing down a couple buildings and moving everybody into, more in the downtown area. They had office buildings over in Dublin and things like that. So we'll see what happens with commercial.
Yeah, the research I've begun is about, how, and it's kind of what you guys are both, Rich and Dad are both talking about. It's like when you have a light occupancy rate in these buildings and they start going under, it's like it's going to affect the small businesses more. And even like a $50 million building, I think that those are really handled by the regional banks. Those aren't, JP Morgan deals. And so it's like, you're going to have kind of two crises interlock here. If you look at the last couple banking crashes we've had, the dot-com bubble, 08, it's never just 2 or 3 banks that fail. It's always around, a couple. It usually cascades down through the system. This time they've been, backstopping depositors and pumping money back into banks to keep the contagion from spreading. I've not followed Europe too close, but I think they're having a similar problem. And so it's going to be interesting when the commercial market, like you're talking, Dad, because of COVID, remote work, people not going back to work, you have, all these vacant buildings with what that will impact as those go vacant is those are paying higher property taxes to the cities.
Right.
So it's going to start affecting, our urban development. There's going to be weird impacts it's going to have, on just the local economies and investors in general. Are they going to see real estate as unsafe? It's going to become a weird thing that I don't know any of us have ever experienced. It does feel like a snowball that's coming.
And I'm not really I'm not an expert, but it seems to me that, let's say I own a big business and I had leased out 30,000 square feet, and then all my workers went home. Well, I had that lease for 2 or 3 or 4 more years, and I've been paying it as time's gone on. But now that the lease is coming up for renewal, and I'm looking at myself and saying, well, I used to have 500 workers coming to the office every day. Now I only have 100. I don't need 30,000 square feet. I only need 10. So we're going to continue to see that contraction as leases become renewed and people take a accounting of where they are and how much they need.
They did probably Columbus, Dad. You're talking about like buildings being light. What do you think San Francisco's like right now with their occupancy rates?
Oh yeah,
and all those tech jobs. It's crazy.
It's clear across the country, around the globe, I'm guessing. But I'm in houses almost every day, and it's still amazing the number of people that are at home working. Because I'll say, well, when's a good time? Is daytimes or evenings better to meet with you? Oh, I work from home, so yeah, afternoons are fine. I mean, I've not done. I'm trying to think. I did a 7:00 listing appointment last week, but that was the first time that I've done like an after dinner listing appointment in probably 6 months. Everything else has been during in the afternoons because people are home working.
Yeah, I didn't even think about that. I mean, I used to always be doing showings late until you would start at 6 or 7.
Yeah,
and it's like it really hasn't been. I never even thought about that.
Yeah,
rush hours change too. It starts sooner and ends earlier. It's like rush hours now to get kids picked up versus getting out at 5.
Like 3:30.
Yeah. Well, I must say that during COVID, I really enjoyed rush hour because it was me and the car out there.
I
love being what do they call us, mandatory workers or whatever.
Yeah,
I love that.
I don't think I've ever made it across Columbus faster than those. I would hop on 70, and I'm telling you, I would be the only car on 70 for 5 or 6 miles.
Yeah.
It was insane.
But I remember the first few days of COVID, I'd come down Sawmill Parkway, and I took pictures. I got them.
Yeah, it's a ghost town.
Me and one other car on the road. It was like, this is nice.
I can do this.
Yeah, yeah. And it's still not bad. I mean, it's nowhere near like coming through downtown on 670 at 5 o'clock. I would drive on 270 and go around downtown because the traffic was so bad. Yeah. And you can still come through downtown and there's no stoppage. I mean, it slows, but it doesn't stop like it used to. So you can tell that there's just not as much action going on business-wise in downtown.
Yeah, it's definitely changed. Although they do have the smart lane now, which I get to go 85 in, blasting by everybody in the shoulder, dodging debris.
While the X is up? While the X is up?
No, never. Only when the green arrow lane.
Yeah, but then it's controlled. Like I was out there yesterday or 2 days ago. It was, the 5 green arrows, 55.
I disregard the speed limit signs typically, but I do obey the green arrow and red X's.
Good. Calling. You have a call from Franklin County Jailhouse.
Yeah, right.
Hello?
You gotta catch me first.
Yeah.
Right. So next week will be interesting. We'll see what the Fed does, and maybe we can reconvene. I'm not sure what day the announcement is, but
I thought it was the 14th.
They usually do Wednesdays, don't they?
Yeah, I'm pretty sure it's the 14th. So yeah, it's next Wednesday.
So yeah, we'll reconvene on the 15th and armchair quarterback it all.
Yeah.
Yeah. We'll talk about how the world's coming to an end. You really
Stay
shouldn't.
tuned next
Yeah.
week.
Yeah. You really shouldn't be thinking about buying it.
Interest rates,
You got to be prepping, putting food supply.
interest rates are down is the good news, but the world's coming to the end is
Yeah.
bad news.
Yep, you got 2 more weeks. 2 more weeks, and it's coming to an end.
I can't give away this stuff.